We've got Ashish Vaidya, who's head of fixed income, currency and commodities trading at UBS India, joining us now on the show. Ashish, to begin with, in the fixed income markets, what's the outlook, at least on the 10-year yield? Where do you see it going?
I think more or less we should see a range of about 805 to 820 levels on the 10-year, the new benchmark. But it's also important to see how exactly the data points, which is due on Tuesday as well as Thursday, how they pan out.
And
so
what's
that's really going to be the deciding factor.
Right. So what's the UBS expectation, Ashish, on the Tuesday number and the Thursday number?
The Tuesday number is 4%, so we are on the higher side. On the inflation WPI number, which is due on Thursday, I think we are at the mean. We are somewhere about 7.5%, which is what the mean market expectation is.
Ashish, afternoon. Now, the RBI has bought over 55,000 crores of government bonds today. Do you think that this liquidity prop-up, at least for the time being, is likely to keep down any worries of tightness that we're seeing in the system?
The liquidity as of late has certainly improved, and broadly my guess is that I think RBI is looking at a trigger of about a lakh crore of deficit, and the moment it crosses that, it will either do a sort of an OMO in the market or will do a CRR intermittently. So I think what we are looking at right now is there's another OMO which is planned for tomorrow, which will sort of ease the liquidity by about 10,000 crores probably if the RBI takes that much till the time we go to the advance tax, and then let's see how do we go from there.
Right, and if you could just also tell us that given the kind of tightness that we've spoken about in the system, do you think that we would need an orderly injection of OMOs coupled with some rate action from the RBI to address the same?
The need for OMO and injection of liquidity clearly arises from the fact that the currency is a little stressed and RBI has to on and off keep intervening in the FX markets. However, so if the currency actually stabilizes and there is no outgo of INR on account of that, then I think we should see a sort of a stable liquidity situation with in fact marginal improvement as the money multiplier actually increases.
Right now, Ashish, to the extent that we've got the new benchmark bond coming in and the fact that all of you are pricing in or rather expecting a quarter point cut on the 18th, can we expect the yield on the new benchmark to possibly fall below 8, or do you all expect it to stay above 8?
See, if it's going to be a 25 basis point cut, maybe in a jerk you could get about 8%. I don't really see it falling below 8. But yes, if you do get a 50 basis point cut, then it will certainly trade below 8.